first rates, and the first rates are now coming any second, and the first rates any second on your screen, and there you go. It is a full house again. It's not a very strong start for benchmark indices, but that really is not the story. The story would be individual stocks once again. The story could really be some small and mid cap stocks once again. Okay, now let me just first talk about the real star today, and I think Anisha spoke about it. It is Orchid Pharma. Hello. Orchid Pharma is surging on very volumes. I think Orchid Pharma has already surged by 14-15%. Now let's look at another stock where I can see a block deal. That is 5-star. I think the block deal has been done at 7:32. I need to use the screen. Somebody is taking it from outside, so please give it back. Then it's 5-star, which has seen a block deal already. Reliance Communication. Now this is like the real tail-ender who's jumping now. 11% higher. Tata Power, the surge and the jump continues by about 1%, and Z is on a 5th gear. My colleague Ankur Mishra has been reporting that looks like there could be a final agreement which could happen between Sony and between the Goenka family on who could be the next CEO for the combined entity. That is something where clarity is expected later this week. But on your screen, Z trending up on very strong volumes. And then where is Sugar, Aisha? I mean, that is one space where yes, no continues.
Yeah, absolutely. So let's just revisit those names. Seeing some more correction now. Barrampur Chini at 400 level, and I think similar is the price trend across the cement sugar sector. Dhampur, Awadh Sugar, Renuka, they're all trailing in the red. What is Zomato up to? That 1% block deal has just happened. The floor price was set at 125. It seems that AVF Growth was looking to sell into Zomato. 1.6% higher for Zomato. 123 is where that stock is. There was also Ircon, which just saw a block deal. Remember, there was that OFS which was going to come into the market, about 0.7% higher for that stock. There was also supposed to be a block deal on 5-star. That is what the reports were indicating, wherein Matrix as well as TPG Asia were looking to sell a sizable stake in 5-star business, 3.25% lower for that stock. And then Titagarh Rail as well, which has launched its QIP. They're looking to raise about 700 odd crore rupees. That stock holds higher by about almost 1% as we speak right now. So that's pretty much it. Let's just revisit the buzzers from yesterday. Tata Power, IEX. Those stocks will just come up for you on your screens. There was also decent action on a Concord, on an MGL, etc. as well. IEX, of course, is pausing a little bit, 0.5% lower as we speak right now. And Concord is holding up higher by about 1% or so. Let's see whether that adjustment in Bharti after the Warburg stake sale is done with, and whether that stock has resurrected itself. Little bit of a lukewarm move. 996 is where that stock is. Kunal, once again, a very flat start, but any individual names one can trade?
Well, yeah, I think HDFC Bank is something which looks attractive at current levels. The stock has consolidated quite a bit, and I think at current levels also looks attractive for a fresh trade.
Okay, Naresh, what about your stock ideas?
So that would be a buy on IGL, which can be a good bounce back trade here. Has made a base around that 400 mark. Could see a move towards 440 in the short to medium term.
Let's bring out the stock price of GMR Airports before we move forward, because I think there has been a sizable block deal there. It's much of an illiquid name, so I don't know if you will really see that kind of price action. Yeah, and I think 75.8 crore shares, so that's almost a 10% kind of equity that you're looking at. 4% lower is where that stock is right now. But Mahesh Patil as well joins in on the show from Aditya Birla Sun Life AMC. Mahesh, hi, morning. Historic week, stepping into a historic month. What's the market construct looking like to you?
Yeah, good morning. So, yeah, I think this month has been fairly good, right? We have seen after the positive results from the electoral in the state elections, I think the markets have taken a slightly positive outlook that, okay, I think the election outcome would be slightly favorable. And globally also, we've seen that despite all the other concern growth slowdown, we've seen a decent amount of rally. And also the good news is that inflation and other concerns, okay, which bothered us for all throughout this calendar year, seems to be easing off, and also rate cuts, okay, in the US, okay, you could see it sometime probably early than what we're looking at earlier. So all in all, I think the market overall flows-wise, if you look at, has turned positive, and the domestic side, we think that things are still fairly steady. A lot of the sectors, okay, which we are looking at have, even after the second quarter numbers, have shown a steady improvement, except barring for a few sectors like consumer discretionary. But a lot of the domestic sector focus are looking good, especially the kind of rally what we have seen in the industrials, capital good, the power stocks. I think this sector, again, is one of the backbone of the economy. And if that is starting to recover, then I think you could see the broader market also sustaining. But I would say that the recent rally, what we've seen is primarily been in the large cap space, which was kind of lagging behind. We have seen a good amount of money flow in the mid and small cap space. I think that seems to have turned around again. There's some catch up over there. But overall, I think as the risk concern starts to abate a bit, I think clearly the laggard sectors which were there, I think they are starting to now perform.
Mahesh, so do you expect markets to stay firm in the run-up to the election?
Yeah, I think given the current sentiment as we move into the next calendar year, right, you could see now fresh allocations, right, from the FIs. And I think looking at the situation, I think they could take a slightly positive view over there. So you could see the allocations could increase in the first half of next calendar year. And with the strong domestic flows which are continuing, I think you could probably see the markets getting into elections slightly on a positive note. And also, as I said, the expectations of the government current polity continuing, I think are much on the higher side at this point in time. So I think this movement could continue. And later on, depending on how the global economy reacts, okay, how do we see the US recession pan out? I think then the markets could probably take a turn from there.
Okay. Right. Mahesh, so what's the strategy going to be from now up until election next year? As a fund house, are there some tactical positions that you're going to be taking? Market cap allocations, maybe book out of small and mid cap spaces a little bit, be more into large caps, also because of their underperformance year to date, vis-a-vis what the small and mid cap spaces have done. Are you taking any of those calls?
Yeah, so I think we are not taking any major call on the election outcome. I think we did not really bother too much about it. I think sticking to our core really in terms of doing a bottom up and sectors, okay, where we think would continue to do well irrespective of the election outcome. I think that is something which we'll be focusing on, and that's been our strategy for some time now. Again, on the large cap, I think we have been slightly recent. The risk reward on the large cap looks slightly better at this point in time. And even in case of market volatility, I think that's where I will find more comfort. So clearly, a tilt towards the large cap stocks is what we are doing in our portfolios. Having said that, I think in the mid and small cap, we are not too worried over there. I think there could be some period of consolidation over there. Again, within that, we've seen a good broad-based rally year till date. And it's a time where some of the weaker companies in the small and mid-cap space, the tail positions, is where we would like to consolidate in this rally and focus on really the stronger companies, because I think that should hold us in case there is a volatility interim sometime next year. And amongst the sectors, clearly the domestic-facing sectors, like, for example, auto sector, where we think that, we've seen a steady improvement over there. Margin outlook looks good. And recently we had launched the auto fund, which also had a good response. And other domestic sectors, whether it is the real estate sector or the industrial sector, where we think the whole investments cycle, okay, which we think actually will post-elections is where the private sector capex could actually gain momentum, and a lot of the industrial capital companies could see steady improvement in the order book going forward. Apart from that, sectors like pharma, for example, which is more defensive in nature, has relatively underperformed, has seen a good traction. We've seen domestic pharma growth has actually outpaced the expectations, and the whole healthcare space also looks good. So some of the defensives, okay, which have underperformed, could also be sectors which one should be looking at this point in time.
Morning, Mahesh. I wanted to also understand your outlook on the PSUs because the perception has changed quite a bit. You've also see overall, it seems like to a great extent the business models have changed, and a lot of these companies have already delivered. Keeping in mind the kind of valuations that they command, what's the outlook on PSUs?
The PSUs have been spectacular rally this year. I think we have a PSU fund which has given more than 40% return. So clearly, I mean, this has been a year of the PSUs, and again, it's not only re-rating what we have seen, but some of the PSUs have also shown a good growth compared to what they have done in the past. And again, a lot of these PSU companies have been a core to the economy, and whether it's in the power sector, railways, defense, where we have seen the overall outlook in terms of growth investments has actually picked up. So I think some of these PSU names have run up quite a bit. So one would be slightly cautious, especially in sectors like, for example, defense or railways. But by and large, I think the overall PSU pack, if you look at it, it's still reasonably priced compared to their historical levels. They would probably look slightly on the higher side. But in absolute terms, if you compare with the broader market, the valuations are still reasonable. And I think where specifically the growth outlook is strong, I think one can still be invested. And though I would believe that with the run-up, what we have seen in the PSU stock and the use appreciation, the government could probably want to monetize some of these things, especially by the end of this fiscal. And that supply, I think, could come in, and that could probably lead to some kind of capping up in some of the PSU names.
The other space, Mahesh, where there's immense curiosity and FOMO feeling as well, has been power. I wanted to understand where within power do you still find value if you are still recommending jumping onto the bandwagon?
Currently, I think we've seen in the power sector, I mean, this has been a sector which has probably been, not done much for many years. And the last, 1 year or so, we have seen heightened activity over there. Again, leading from the fact that, after a long period of time, we're seeing actually now capex intensity in the power sector starting to move up because of the underinvestment, what we have done, especially in the thermal side. The peak deficit has kind of gone up, and then we need to really step up our investments over there, both in coal as well as in the renewables. And that is seeing a lot of interest back in the sector. But I think some of the rally what we've seen has probably slightly gone ahead because this is a sector where it takes some time, right, in terms of you decide plans and start to execute. It's a long gestation period. So while the overall outlook in the sector looks good and is improving, I would say one needs to be a bit cautious over it. I think it can still be a good, steady, especially the power utilities. It could still be a space where you could still look at it where there's still value. Though, again, I would say compared to the recent historical multiple, it's in the highest. But if you really look at during the peak when the sector was, if you compare to that level, then probably one can say there is still some upside there.
Okay. Mahesh, why have crude and bond yields come down? We can look at, say, okay, great news, but isn't that an indication of some recession is around the corner?
Yeah, I mean, so obviously oil prices, okay, there are multiple other determinants there in terms of how one is the demand side of the equation and also on the supply side. So I think market is already trying to factor in that you will see some slowdown, especially in the US. The debate is whether it will be a soft landing or you could see a hard landing. But where the inflation is kind of trajectory is, and with commodity prices also coming down. So I think if that is the scenario, if it is the rate cut is more led because of, or rather the expectation of the bond is coming down is more because of inflation trying to come under the control and the target which the Fed has, then I don't think it's something to be worried about. But I think that to some extent, I think looks to be the reason why the bond yields have come off. It is also expectation that inflation expectations are likely to be much more lower than what it was expected to be earlier. So while we say the slowdown concerns would definitely be there, but I think that is something which the market, at least the broader market, is I don't think it is expected to surprise negatively more than what the current expectations are.
All right, give us a sense as to what the outlook is when it comes to the overall earnings momentum, because we've been talking to some experts and they say that perhaps there could be a concern when it comes to a slowdown in numbers within the consumption space. Are you worried?
So, I mean, some of the commentary recently from after the festive season, we haven't seen material pickup in consumption, which was expected, especially on the rural side. And that could lead to some kind of dampening in terms of expectation, especially on the consumer side. You're right about that. But I think in the consumer space, while the top line growth will still not probably be as one would have expected, the recovery is still slightly slower. But on the margin side, I think things are still looking pretty good there. The growth in the bottom line would be driven by margin improvement, and that has been aided by fall in the commodity prices, both in terms of crude and even other food prices have also kind of come off. So I don't think there should be major concern in terms of the earnings growth or downgrades to earnings in that sector, because the margin lift will probably take care of 1 or 2% slowdown in the volume growth which could happen over there.
Okay, Mahesh, great to have you on the show. Thank you so much for taking the time out and speaking with us today.
Thank you.
Let's just discuss what else is happening in the market right now. While it's definitely a bit of a tempered start, sugar's not looking all that sweet for a second consecutive day. Most of these stocks are in the red as we speak right now, still drifting lower, although there has been some amount of recovery as well from where they started off. But that's not pretty much across the board. Balrampur Chini, which is I think the only FNO name, that's where you're seeing a bit of a back coming in. LIC Housing, that's your big story today, 2.6% higher. Look at the moves coming in on HAL. They announced that tie-up with GES today, 2% higher for HAL right now in trade. There's Z, which has been going from strength to strength since last week, 2.5% of an uptick there as well. And today it's actually metals where the trend is. So JSW Steel holding up 2%, NMDC higher by about 2%, Hindalco also is looking strong. And then of course there are others like in HDFC Bank, IndusInd Bank, L&T, which are all looking good. But it's not all that bad. You know, I mean, to think of it, we're already closing in on that 21,100 mark on the Nifty futures at least, which is 29 points away from that. Little bit of consolidation is par for the course. Even on the spot Nifty, I guess, Nikunj, level of 20,950 is no reason to complain whatsoever.
You know, if you consolidate even for rest of December also, I think is entirely acceptable. Trust me. I mean, the run-up has been, what, 10-11% from October low for benchmark indices, about 17-18% for small cap stocks. Even the bank Nifty, which was like a backbencher, has really, you know, come back with a lot of force and, you know, gusto. So even if you consolidate for the month of December, I think it will be called as a very healthy consolidation. But markets are markets, you know, I mean, they can always surprise you. You can look at yesterday's price action and say, okay, it was thanda, but that's perfectly acceptable. You don't want things to become super hot, because then you run a risk of run a risk of reaching a bubble territory. Large cap valuations are reasonable, there is no problem. Mid cap you have to be selectively, and small cap in general you got to be very choosy. SMA you should avoid right now. I mean, if you're looking at fresh entry levels now, then I think SME and those real tiny tunes, they do not offer that margin of safety. If I have to talk about a very standard you know, approach in terms of an asset allocation. But where is Paytm? Let's look at it. I mean, are buyers coming back in Paytm? Last I checked, it was flat, and there you go. No large aggressive buying, I think, is there in Paytm per se. A couple of block deals from the morning, 5-star, Zomato. Zomato is holding at 120. A lot of supply is coming around 115, 120 for Zomato, but it's just been unusually strong. I think 3-4% of equity has already changed hand from SoftBank at these levels. And 5-star recovered. The block deal was at a discount, and that discount now seems to be, in a sense, evaporating. But it's turning out to be a very decent day, so to speak. Shantanu Roy, Chairman and Managing Director of BML, now joins us. Mr. Roy, good morning. Thank you for joining us. Now, the first half was pretty decent for BML. What about the second half in terms of order book guidance, and with reports of order decisions getting deferred, could that have impact on your order flow guidance?
You see, when we had planned a year-ending order book of 17,000 crore, and at that time also I had very clearly mentioned that provided some of the rail metro tenders, they get finalized within the current financial year. Unfortunately, what has happened is a couple of tenders have got pushed. One is the Chennai Metro, which is a JICA-funded project. It has now been pushed to, the bid submission is pushed to February 2024. And another tender was the Line 6 Mumbai Metro for 108 cars, which has now been discharged. And it is understood that MMRDA is going to club Line 4 and Line 6. And together we are going to, they are going to bring out 342 cars, the tender for 342 cars, which should come sometime this financial year itself, maybe in the last quarter. And both these opportunities, they should be finalized in Q2 of 24-25. So there is nothing to, I don't think it has anything to do with the elections, or it is a normal process of the tenders being finalized, the specifications being worked on. So that is what I understand.
Right, morning. Now, considering that the tenders are being pushed back and will flow into FY25, how are you projecting your order inflow growth for FY25? Do you think it'll be better than what we saw in FY24?
FY25 is still very far off. If everything goes well, in FY25, we should have an order inflow of at least 15 to 20,000 crores, provided the tenders that have been pushed back, plus some new tenders, plus some tenders which are already ongoing, they are all finalized. Definitely, it will be better than this year.
Right. Okay, can you also talk about your current order book? How does the split look like in terms of mining, defense, and railways?
The split more or less remains the same. Presently, we have an order book of around 13,000 crores, out of which rail is around 55, defense is around 30, and mining has picked up now. This is the time when mining picks up. Mining generally picks up from the second quarter, third quarter, and the fourth quarter. So mining makes up around 15% of this 13,000 crore. So that is how the order book looks as of now. And we expect that in the balance 4 months time, we'll be able to book another 3,000 crores of order, mainly from the mining and some from the rail sector. And of course, there are certain projects in the defense which are under finalization, and we should be closing those orders, securing those orders.
Now, the centre also has approved the defence acquisition projects worth about 2.23 lakh crores. What are the implications for BEL of this in particular? Are there any significant orders that you can highlight that are in the pipeline?
I think that 2 lakh crore acquisition was for a different space. I think it was for the aero sector. And BML is not in the aero sector. We are not there in a big way. We have only taken baby steps in the aero sector. We are doing some structures for ISRO. We are doing some motor casings for various missile programs. And yes, we are now planning to get some good orders in the aerospace, especially for this, along with HL, for their new projects as a GHE, GHA. We hope to get a good order for the aerospace as well.
Right. So considering you're also delving into other segments like aerospace, how does the order mix look like going forward, say, for the next 2 to 3 years hence?
The three present verticals that we have, last year mining contributed 50%, rail contributed 27%. When I say rail, it's rail and metro put together. And defense and aerospace contributed 23%. The next 2 to 3 years, what we can expect is that mining will still be leading as a single vertical with around 35%, whereas the other two business verticals, they will make up around 60 to 65% of the company's turnover.
And you're expecting to grow at a 20% CAGR over the next few years. Which segments do you think is going to be the major growth driver? Because you were also targeting a revenue of 7,000 crores by FY26. Are you on track?
If we are able to grow at 20% this year and the next year, then FY26 7,000 crore is very much likely. It's very much on the anvil, and it will be driven by increased rate of growth in the rail and metro and defense and aerospace, whereas mining will continue to be the to provide the baseline at least for the next 2 to 3 years, because mining is already we have the regular orders coming in, and we have a low turnaround time. Whereas for the defense and for the rail sector, generally the turnaround time is a little longer.
Right. You're also expecting improvement in margins going forward, right? What are the factors you think will aid the same?
Talking about the margins, last year we almost touched double digits, 9.3% of EBITDA that we achieved last year. This year, in the half year itself, we are at around 7.5%. So definitely there is a possibility of a 200 BP growth over the last year's EBITDA. And that will be again driven by the product mix that we have. The product mix that we have for the rail, the product mix that we have for the defense, so and the exports turnover. So these three factors will be responsible mostly for the increase in the EBITDA.
Now, BML is a divestment candidate, and successfully divesting government stake in a private player could lead to sharp re-rating. When will this final disinvestment happen?
The subject of divestment is something which is handled by DIPAM. So they are the right people to, give an update or even give some input on this. BML is in no way involved in the divestment process. What I can say is that our mandate is to have a quantum jump in growth for the company so that we can unlock value, we can create value, and at the same time maximize the value, maximize the gain to all the stakeholders. And that includes the government also, which is the largest stakeholders at present. So we have to do our job of ensuring growth for the company, and the agency which is responsible for the divestment, I am sure they will be in a position to really comment on the divestment status.
All right, thank you so much for taking time out and giving us a sense as to how business is shaping up. That's the word from the management of BEML. Order inflow to the tune of 15 to 20,000 crore rupees and margin growth of 200 basis points next year versus what we saw last year. We'll take a very short break. Stay with us. Lots more corporate voices lined up. Thanks for staying on with us. Still tuned into First Trades, and as things stand, the markets are just about holding on to those levels, up about 0.2% for the Sensex as we speak, and for the Nifty, 20,967. But let's put the spotlight then on Sami Hotels. The company is talking about a turnaround in their operations as well as an acquisition-led strategy. We've got Ashish Jakhanwala, Chairman, Managing Director and CEO, joining in. So much for taking time out. I just want to start off by talking about this focus on a turnaround in operations that you said will help generate returns. What exactly is the strategy in place to turn around your operations?
Hi, thanks for having us. So over the last 12 years, we built the whole business around identifying underperforming, undermanaged hotels across India. And then effectively, we have a programmatic approach to improve the product, bring a strong brand, have very strong asset management capabilities. And by applying all of those three, we've seen that the performance of these hotels can really materially change, So that's how we've grown over the last decade or so. As of date, actually, we have 4,800 operating rooms, but within that, about 900 rooms are waiting for that turnaround. So we expect to initiate that in the current quarter and complete all of that in the next 4 to 5 quarters. And that would actually create a huge upside impact on the performance of the company as we see it today.
The turnaround of those 900 rooms. And, as you said, that a lot of the properties are in the mid-scale to upper mid-scale category. Your average ARR is around 5,000 odd in FY23. So how do you plan to grow your ARR, especially in light of the fact that we have been seeing healthy domestic demand?
So yeah, absolutely. So there are two parts to that. One is market driven and one what we are doing. We actually see a very strong demand for business hotels in key cities. And if you know about our portfolio, almost 90% of our revenues come from the key metros. And those are the metros where we are seeing really good growth in office space, really good pickup in the aviation traffic. And those are the two big pivots for us to see strong demand. The supply is negligible, and that is effectively going to push the average room rates higher. But besides those market-led factors, as I said, that we have a portfolio which is a part of our portfolio is waiting for that re-rating through some renovations and rebrandings. And that will also have a significant impact on the average rates across the portfolio over the next 4 quarters. So there are both factors in play here, market-led and what we are doing as a company.
Your revenue, which broadly comes from the Marriott group. I was on your website and I was looking at your hotels, and a lot of Marriott properties are in your fold. What's the percentage of my business revenue which you get from them?
So if you look at the total portfolio, you're absolutely right. About 50 to 60% of our revenues will come from hotels which are branded under Marriott, and the balance will be split between Hyatt and Intercontinental. So we have a very good spread of brands and operators in our overall bouquet, but about 50 to 60% is hotels which are branded under Marriott flags.
And at a time when more and more hotels are, let's say, following an asset-light model, aren't you thinking on the other side? Because that's the time when you keep your balance sheet less levered, debt is not a challenge. Right now the cycle is strong, it could be a 2-3 phenomenon, but then after that, hotel is ultimately cyclicality.
So you're absolutely right. I think what is important is to be capital efficient. And if you see, we've taken through a lot of hard work and pain over the last decade to install a very strong capacity. So as of today, we are the 3rd largest owner of hotel rooms in India. The IPO allowed us to deleverage the balance sheet to a reasonable level. The current cycle, which in our opinion will last a few years, will be also used to continue to deleverage the balance sheet to a point where effectively it's stable for all times to come. And then effectively the current installed capacity is producing very healthy free cash. And that's really the free cash which is going to effectively increase the capacity that we have in our portfolio. So we've done the hard work, both financial and manual in a way, over the last decade, and now we are effectively reaping the benefits of the capacity that we've installed. In terms of asset light versus asset heavy, I think we are seeing very strong operating leverage in hotel industry in India for the next several years. And if you are in a cycle where you see strong operating leverage, then being an owner which controls 95% of the revenues, 5% are given to the operators, is actually a great business to be in. But in addition to that, very similar to peers, which currently will have about 10 to 15% of their total revenues coming from asset light. Even in our portfolio, we have about 13% of our revenues coming from a quasi asset light strategy, where we actually, instead of owning the buildings, will have long-term variable leases. These are leases which are 40 to 60 years. These are leases where we share a percentage of our revenue with the landowner or the building owner as a rent and not a fixed rent. So we also have an adjacent strategy, which actually today is contributing almost similar to the top line as would be for some of the other peers we have in the sector.
All right, good to know. Thanks so much for taking time out and joining in and giving us a viewpoint as to how your business is shaping up. Tell you what, we'll slip into a quick break. Do stay tuned. In a few minutes from now, we've got the RBI policy.